September 15, 2008. New York City woke up like any other Monday morning. Subways were crowded. Coffee shops were full. Wall Street was alive with movement. But inside a glass tower in Manhattan, history was about to collapse. A bank that had survived wars, depressions, and financial panics for over 158 years was about to disappear. Not slowly, not quietly, but in the most dramatic financial collapse the world had ever seen. Its name was Lehman Brothers. By the end of that day, over $600 billion in assets would vanish, global markets would freeze, and the modern financial system would come closer to total collapse than ever before. This is the story of how one of America's most powerful banks became the symbol of global financial failure. Lehman Brothers was founded in 1844. Three brothers, Henry Lehman, Emanuel Lehman, and Mayer Lehman, immigrated from Germany to the United States. Their first business wasn't banking, it was cotton trading in Alabama. But the brothers were smart. They realized early that real power wasn't in selling goods, it was in financing trade. Over decades, Lehman Brothers evolved from a small trading firm into one of Wall Street's most respected investment banks. They financed railroads, they supported industrial expansion, they helped shape modern America. By the 20th century, Lehman Brothers was no longer just a bank, it was an institution, a symbol of stability, a symbol of intelligence, a symbol of trust. Or at least that's what the world believed. In the early 2000s, America was optimistic. Interest rates were low, credit was easy, and home ownership was promoted as a guaranteed path to wealth. Banks told people, "Buy now, prices only go up," and people believed them. Houses stopped being places to live, they became financial assets. You didn't buy a home to stay in it, you bought it to refinance it, flip it, sell it. Wall Street saw opportunity, and Lehman Brothers was right in the center of it. To fuel the housing boom, banks began issuing mortgages to people who clearly couldn't afford them. Low income, unstable jobs, poor credit history. These loans were called subprime mortgages. On their own, they were extremely risky, but Wall Street had a solution. Banks bundled thousands of these risky loans together, turned them into complex financial products, and sold them as safe investments. These products were called mortgage-backed securities. Lehman Brothers didn't just sell them, they invested heavily in them. And rating agencies labeled them AAA, the highest possible rating. Investors trusted those ratings. After all, how could something rated AAA ever fail? Lehman Brothers began borrowing massive amounts of money to increase profits. This is called leverage. At its peak, Lehman was leveraged more than 30 to 1. That meant even a small decline in asset value could wipe out the entire firm. But profits looked incredible. Executives were rewarded, bonuses grew larger, warnings were ignored. Risk managers raised concerns, they were sidelined. Because when money is flowing, nobody wants to hear bad news. Lehman believed housing prices would never fall nationally. That belief would destroy everything. By September 2008, cracks began to appear. Housing prices stopped rising, then they began to fall. Borrowers defaulted on loans, mortgage-backed securities lost value. Lehman Brothers started bleeding money, but instead of admitting the problem, they tried to hide it. Assets were overvalued, losses were delayed, confidence was artificially maintained. Markets sensed something was wrong, trust began to fade, and in finance, trust is everything. In September 2008, Lehman Brothers was desperate. They searched for buyers, they asked for government support, they tried to survive one more day. But unlike other banks, the U.S. government decided not to save Lehman. Officials believed markets needed a lesson. They believed letting Lehman fail would restore discipline. They were wrong. Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in U.S. history. Markets collapsed. Banks stopped lending to each other. Credit froze. Businesses couldn't operate. Fear spread globally. If Lehman could fail, no institution was safe. Europe's banks collapsed. Asian markets crashed. Global trade slowed to a halt. Millions lost jobs. Homes were foreclosed. Retirement savings disappeared. The crisis didn't start in one country anymore. It was everywhere. The U.S. government launched massive bailouts. Trillions of dollars were injected into the system. Banks were saved. Corporations survived. But ordinary people paid the price. Trust in institutions was shattered. Lehman Brothers collapsed because of one mistake. It collapsed because of greed, blind faith in ratings, excessive leverage, weak regulation, and the belief that size equals safety. Too big to fail turned out to be an illusion. Lehman Brothers no longer exists, but its shadow still looms over global finance. Every boom creates the seeds of the next collapse. The question is not if another crisis will come. The question is, will we recognize it before it's too late?